Welcome to the Daily Briefing from interest.co.nz. I'm David Jaston. Today we review the September level of housing credit, look at the money supply changes, update the ASB Housing Confidence Survey, and we'll wrap up with a look at what the other media are reporting. September 2007 will go down as the month where housing credit exceeded $150 billion for the first time. That's $150 billion in credit supplied by both banks and non-bank financial institutions. The great bulk of this credit is supplied by banks, and this portion is growing faster than the tiny upstarts. But those non-bank institutions are able to celebrate a milestone of their own. They now supply $8 billion worth of that housing credit. But the bank share is growing faster, up almost 14% year on year, and that share is almost 95% of the total market, and in turn the four dominant banks have most of that. At last count, Kiwibank was the biggest other bank with a minuscule 2% market share, itself way less than half the tiny non-bank institution market share. To put this into perspective, the Reserve Bank has calculated that the total value of our housing stock is a massive $608 billion. That means that those of us with houses have borrowed about a quarter of that value from the banks on average. Interestingly, while this proportion has been creeping up slightly this year, it is still way below the 29% owed at the end of 2001, and about the same as was owed on our houses when the Reserve Bank first started collecting this data in 1998. The broad measure of the money supply we track, M3, has started to grow again. It fell in absolute terms from April to July, but with growth over the past 2 months is now back just above that April volume. What is interesting is that about half of the recent decline has come from the M1 components, that part of the money supply that measures changes in checking accounts. The recent levelling off in the growth of the money supply reverses a 3-year trend and may be early and real evidence that credit is about to get tighter and growth more restrained. But countering this will be the big boost that will surely come from the huge increase in the dairy industry returns. That will flow through to farmers and out into the wider economy, counteracting the recent trend. In fact, those first checks have just started flowing to farmers. The dairy wall of cash is now on its way. With credit growth growing strongly as well, we'll no doubt see this upturn in the money supply continue. And the last thing the Reserve Bank will want to see is the politicians priming the pump, even if it is just giving back to taxpayers what they didn't use or need. With house prices levelling off and interest rate hikes starting to bite, confidence in the housing market has cooled. Today's release of the latest ASB Housing Confidence Survey shows that 18% more people think now is a bad time to buy, compared with a negative 14% level at the last survey in June. And a lot less people now think house prices will rise over the next year, and a lot more people think they will fall. Overall optimism is down from a net 32% positive in the previous survey to a net 12% this time, and that's a big fall, even for a 3-month period since the last survey. Of course, the big question is how long will this housing funk last? Most analysts suggest it will be a shallow slowdown, with increased dairy earnings flowing through to the economy, boosting prospects for 2008, helped by electioneering tax cuts. But the real number to watch is net migration. This is the leading indicator for house prices. If long-term migration turns up, it is likely house prices and housing confidence will rise again. And the particular number to watch in migration is the level of outflow to Australia. And finally today, a quick look at what the other media are reporting. Tomorrow, the US Federal Reserve will announce its latest interest rate decision. Last time, they cut the Fed funds rate by a whole 0.5%, from 5.25% to 4.75%. However, the credit crunch continues to bite, so another cut is likely. Some are picking another 0.5%, but sentiment has shifted back in the past week to a more likely 0.25% drop. That will accentuate our interest rate advantage over the US dollar. This expectation has no doubt fueled the rise in our exchange rate over the past week. It's now up to over the 76 US cent level. And by the way, Sweden has today raised its official interest rate by 0.25% to 4%. You get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.